everyone, GM. Welcome back to another episode of Overpriced JPEGs. I am joined today by Jake Brukhman, who I had the pleasure of interviewing actually fairly recently at Permissionless in a panel with several others about how NFTs are changing and shaping culture. And we now have him on the podcast today. He is the founder and CEO at CoinFund, which is a blockchain-focused investment firm. It's been around for 7 years?
Yeah, it's going to be 7 years on July 1st.
Wow, happy anniversary coming up.
Thank you. Thanks for having me, Carly.
And you also helped to seed and raise, you're going to correct me on how I phrase this, but Metaversal, which is sort of a subset of what you do in that it focuses specifically on NFTs and the metaverse. Do I have that right, Jake?
Yeah. Well, Metaversal is one of our portfolio companies, but it's one that we very actively incubated, accelerated. We feel like this is a team that we work with, almost on a daily basis and certainly a weekly basis as they kind of dive into the NFT space. And we almost think of them as our NFT arm or strategy.
Great. And investment company, is that what it is?
Think of it as a venture studio for helping, corporates, IP owners, brand owners, projects, traditionals, crypto natives, to bring NFT strategies to market and also build a portfolio of NFTs kind of from doing that and from the secondary markets.
I want to talk to you about how you or Metaversal think about valuing NFTs. I think as we're seeing this bear market hit, it's like that's a big question that's on my mind is like, how do we value this asset class? But before we get there, I want to dive into the macro situation with you. Again, you've been in crypto for 7 years. You've been through all the bear markets. And while CoinFund is not exclusively a venture fund, you certainly make a lot of venture investments, and that's a subset of what CoinFund does. We hear a lot right now about the venture market, about the slowdown, everything's drying up, liquidity's drying up, valuations were way too high. How is that impacting you? How are you seeing that impact the kind of private crypto blockchain company market?
Great question. So I think to kind of frame it, we talk to our institutional investors every day, and we definitely are getting the sense that they feel that there's a bunch of macro environmental changes that are coming out there in kind of the broader economy. They feel very bearish. They're also observing correlations between crypto and kind of macro factors, and they're making the conclusion that it's also going to be like a pretty tough time for crypto markets as well. Now remember, crypto markets are, we could broadly also separate them into liquid markets. These are all the high cap assets and other tokens that are out there trading on 24-hour crypto exchanges and DEXs. But there's also the private equity markets where founders are raising money from venture capitalists or crypto funds like CoinFund. And those markets actually tend to move slightly differently. So I think one thing to say is it's true that we've observed some correlation in crypto, but that correlation isn't like all encompassing, right? If you look at NFT GMV, NFT revenue, this actually has been much less correlated to macro factors than like Bitcoin or Ether. And if you wanted to build a portfolio, of assets that were still like a lot less correlated to the macro environment, I think you could in crypto. I haven't run that analysis on what those assets would be, but I think you could. And also generally like correlations between different areas of crypto, it used to be that everything was like super correlated to Bitcoin, but now, we have like DeFi space, NFT space, Web3 space is really moving according to their own logic and their own cycles of building and stuff. And so there's a lot less, I think, correlation than there was in the past to Bitcoin in general. When you and I were at Permissionless, right? Did you feel like Permissionless was a bear market conference?
No, I went from there to VCon, and I literally tweeted a picture of me at those conferences saying, "What bear market?"
Yeah, exactly. So what we saw at Permissionless was, first of all, it was like probably the best conference of the year that I've been to. Very healthy mix of institutional people, investors, founders, technical people, but the subject matter wasn't like overly technical. It was a good environment over in Palm Beach, right? And so it really felt like there's more capital in the space than ever for venture. There's a bunch of traditional VCs coming in, finally taking crypto pretty seriously. There's more founders building than ever on the back of that capital, or the future promise of new capital that's being raised. There's more Web 2 people than ever coming in and lending expertise to taking, applications to market to the consumer, right? Like these are folks from Amazon and Facebook and Google who have experience, building applications at scale, experience with UX, experience with mobile, really like starting to get into the consumer side of crypto. And this is very new. We've been investing in infrastructure for the last decade, you might say, in the blockchain space. And so I would say that like I'm much less bearish than my average institutional investor right now on crypto markets. And well, of course, I'm seeing sort of the volatility in the liquid markets, but and in private equity markets, we could still see impact. But for the most part, none of the theses have changed for a lot of these projects, startups, networks, and yet they're pretty cheap. So, if you're a manager coming into this market now with a new fund, which a lot of folks are, you have a bunch of cash, and this is a great time to go in. I mean, CoinFund was founded in 2015 in the depths of a terrible Bitcoin bear market. There was like nothing going on in crypto. Bitcoin was between $200 and $400 for 2 years, 2015, 2016. And we had like 1 year of, ICO boom. And then January 2018, everything crashed. And then for a year, it was just painful bleeding. And then in the early, 2019, folks were starting to think like, hey, maybe Bitcoin's going to come back. And it started to, and then boom, it crashed again. And there was a bear market for another year. And then in 2020, it started to come back. And then in March of 2020, coronavirus crash happened. It was like devastation yet again. So we had a, 2 year plus kind of bear market. But what I will say is those were the moments when we as an investor made some of our most impactful investments. Like in that 2018, 2019 time period when things were so hard and a lot of companies couldn't raise a dime, and assets were very cheap and liquidity was low, those were the moments when there's an opportunity to position in the best projects that are going to come out of that environment, in the next cycle. And that's kind of how I'm feeling about where we are now. This is a lot of people say this is a bloodbath. I say this is an opportunity bath.
Yeah. I feel it. I mean, I think the vibe around the crypto space is actually better than it's been for the last several months. And I have at the risk of, I guess, like being the meme, like I want to build something, like I'm like, it feels like it's a really fun time to just kind of get serious and dig in. It sounds like you are saying though, are you seeing like, are we seeing private crypto companies kind of marked down from where they last were able to raise, for example, and your feeling is, well, the strong ones will come out even better because of this?
I definitely feel like investors, when they negotiate with founders, they'll, in an environment like this, they'll make that case. They'll say, hey, you never know what's going to happen 6 months from now or coming into this bear market. And so therefore your valuation should be lower. So I think just like on a negotiation basis, like we do see a little bit of pushback, but founders aren't starting there, right? Like the average seed round has been 30 million for the last year and a half. And, most of these rounds were at that stage, like we see between 20 and 40 million. And that really hasn't moved, in that time. So again, we might say like, hey, it's just that the bear market hasn't gotten around to you guys yet. But I really, I'm skeptical that we're going to see like a ton of impact there.
Living a bankless life requires taking control over your own private keys. And that's why so many in the Bankless Nation already have their Ledger hardware wallet. And brand new to the Ledger lineup of hardware wallets is the Ledger Nano S Plus, a huge upgrade to the world's most popular hardware wallet. With more memory and a larger screen, the Nano S Plus makes it easy to navigate and verify your transactions. And the paired Ledger Live desktop app gives you increased transparency as to what is about to happen with your NFT. What you see is what you sign. The Nano S Plus gives you the smoothest possible user experience while you're doing all of your crypto things. So go to the Ledger website to check out the features of the new Ledger Nano S Plus and join the waitlist to get yours. And don't forget about the Crypto Life card, also powered by Ledger. The CL card is a crypto debit card that hooks right into the Ledger Live app, right next to all the DeFi apps and services that you're already used to doing, like swapping tokens and staking. So if you don't have a Ledger hardware wallet, go to ledger.com, grab a Ledger, and take control over your crypto. If you're starting on your NFT journey, you need MetaMask. This is your tool to unlock the world of DeFi and NFTs without giving up custody over your private keys. MetaMask is both a secure in-browser wallet and also a secure bridge for your hardware wallet so that you can connect to any Web3 enabled website. You can now trade tokens with any DEX or aggregator. MetaMask Swap gathers real-time pricing information across the DeFi exchange ecosystem, allowing you to select your best price while getting all of the MetaMask benefits of self-custody, lower gas costs, and increased transaction success rates. MetaMask also has a fantastic mobile wallet, which I use while I'm out and about. And I use it to collect POAPs, NFTs, and use it for all my DeFi things while I'm away from home. If you haven't downloaded MetaMask, you gotta try it out. Download MetaMask for desktop and mobile at metamask.io, or load up your Ledger, Trezor, Keystone, or Lattice hardware wallets so that they too can get into Web3.
And then in the super liquid, or the more liquid assets, call it, and these more NFTs, things that can be traded on exchanges, are we bouncing along the bottom here, or do you think there's further to fall?
When you say that, like, what metrics are you thinking about?
I'm thinking, oh, well, this gets into actually a tweet of yours that I love. I would say floor price, which I think you made the savvy point that floor price has nothing to do with price. That's an offer to sell. But, in terms of, I don't know, Bored Apes, I don't know what it's at the latest. I know it dipped below 100, but like 90 ETH, is that whatever it is at? Like, are you think those kinds of the prices that we're seeing, or what people are demanding they be paid for their assets, will that stay where it is?
So you're right that I've tweeted a lot about this over the last year or so, but I think like floor pricing is just like a terrible, terrible metric of what's going on in NFT space. I mean, I think like my core metric when someone asks me like what's happening in NFTs is GMV, right? So if we pull up, let's see, we could do this right now. If we pull up kind of like the 30-day, what we see is that we're in the last 30 days, we've generated something like 3.3 billion of GMV in NFTs.
Can you define GMV for folks? I think I actually made you do this on the panel as well.
All right. Gross marketplace volume, right? So just the number of sales that are happening like in the NFT space. And so what's one of the reasons why I talk so much smack about floor pricing is that it's the kind of statistic that could be going down, but the overall sort of health of the space, and overall activity could be like very much going up, and that statistic won't tell you that. And so this is exactly what we're seeing, right? Like you're making the point that floor prices are dropping for certain series, but I'm making the point that, look, our 30-month volume is 3.3 billion, and that's not less than, in most of the months that have been in the last year or so, right? And if you multiply that by 12, right, you get something like close to 40 billion, which is still in kind of this range that we've been saying, like NFTs are run rating, depends on the day, but like 30 to 60 billion of annualized gross marketplace volume. And that's like, almost as big as the whole global art world, right? And that doesn't seem to be going down, even though like Ether and Bitcoin have been falling dramatically over the last, several weeks.
So I guess that's the question. Do you think that will go down, or do you think this is, activity will only go up from here and we're in sort of the lulls of the space?
I mean, like on a medium to long-term time frame, I think the marketplace volume of GMVs is going parabolically through the roof. Is there going to be volatility to it short term? Of course. But I don't see it like dropping as much as, as stocks are, or as big cap crypto assets are.
I think that's fascinated me. I would not have predicted that. I thought NFTs, being a newer asset class, were going to be hit the hardest whenever the bear finally came. So I think I'm still trying to like understand why it has felt as good as it has with equities going so poorly.
That's right. So we were going through some like deeper stats on this yesterday with the analyst team at Metaversal, and what they actually showed was at least on Ethereum, like ETH denominated NFTs on Ethereum, the Ether denominated volume was in fact dropping, but the number of like units flying off the shelves was dramatically going up. And what that is actually saying is that like it's not that people are stopping to trade NFTs. Like that's not what the dropping volume means. What that combination of statistics means is that people are preferring cheaper NFTs in this market. They're feeling like, oh, this is like the time to get a great deal, right? And they're going into kind of like cheaper items, with the eye that, 6 months from now, 12 months from now, whatever it is that they're thinking, that those items are going to come back ETH denominated and they're going to make a fantastic return. And so this is another example why like you can't just rely on like one statistic like to tell you what's going on, because again, GMV might be dropping, but consumer behavior like might be just changing in some ways that are very bullish.
Well, and we're seeing not just cheaper assets, we're seeing cheaper chains, right? We're seeing, I think, Magic Eden, the marketplace on Solana, for the first time ever, exceeded OpenSea in terms of daily volume. Do you have thoughts about where this nets out for other alt ones? Perhaps I know Metaversal has invested in funds across multiple chains, and CoinFund, I'm sure, as well.
Yes.
How do you think that plays out as we maybe emerge out of the bear market someday?
Well, it's really cool, like at a very high level, right? It's really cool to see that Solana has sort of emerged as, a major like alternative venue for NFT trading. And what we also see is that Solana NFTs they tend to be like cheaper, as you noted. But if we step back and say, how does this all play out? Did this one chain win, the NFT world or something like that? Our thesis is very specific here. We think we're in a general trend where there's a lot of chains. The market is almost unrecognizable since 2019 when people were saying like, you can't bet on an alternative chain. Ethereum's got all the developers and they have all the attention and they've already won and it's totally like useless to even compete. And we went from that world to a world where investors, participants, engineers, founders are increasingly like able to choose alternative chains for financial reasons, for technological reasons, for strategic reasons. And so we now live in a world where the number of chains is a lot and it's going to keep going up. And when you have a lot of chains, that creates a lot of demand for interoperability technology, right? You want to connect the chains together. Now, what's also at the same time really interesting is that interoperability technology is maturing and sort of going to the next step in its state of the art, like sort of as we speak, right? Interoperability has been focused for the last, forever, has been focused on essentially like moving tokens between chains, like connecting chains together, moving tokens. But what we're seeing now with companies like, Layer Zero, Abacus, and others, is that we're going into more of an omni-chain situation. What does that mean? Well, these new interoperability technologies, they're more general. They allow like cryptographic messages essentially to be passed between different blockchains. And what you can build on that is, sure, token transfers, but also NFT transfers, also being able to read the state of one blockchain from another blockchain, being able to call a method on a smart contract in another blockchain from a different blockchain. And what does that all amount to? Omni-chain assets. Omni-chain assets are tokens or NFTs or other assets that like don't live on a particular chain. They live on all the chains. And what that does is it alleviates the customer, the mainstream user, the newcomer from having to think about like, what backend am I on? We say like when you're driving a Tesla, you're not thinking about like the data center that's required to fit the AI model that's, driving your autopilot for you, right? Consumers don't think about that. So it's really odd that like crypto consumers should have to think about that as well. And what this omni-chain interoperability technology does is it sort of encapsulates kind of the back end, allows the mainstream user to just focus on like, hey, I'm buying NFTs. I'm doing business here. I'm not thinking about what data center I'm in. And the choice of of blockchain is still relevant, just not to the consumer. It's relevant to the engineer. It's for the people who are making the technological decisions of how a particular app should be implemented, or how a particular decentralized network should be implemented. And it's similar to like startups making the choice between like AWS and Google Cloud, or in some sense, right? In Web 2. Like, you don't think about that when we're using, this platform that we're on right now.
How do you keep up to date and determine what you are tracking at any given period of time in this space, given that you have eyes on like everything across blockchain, which is really just massive?
We have a team of 34 people
That
that
helps.
works full time in blockchain, and it's still not enough to cover
Yeah.
everything.
And do you like just from a tactical how you run your business perspective, unless you're giving up trade secrets, like how do you bucket the departments? Do they evolve as do you have like a team that's thinking about interoperable chains, or like how do you structure your team?
Yeah, it's a great question. So we have, or we're about to have, 9 people on our research team. There's 4 partners at CoinFund, managing partners who are doing deals. So that's 13 people kind of exclusively focused on investments across all types of crypto opportunities. And historically, what's been really interesting about our team is that they have worked across venture and liquid analysis, right? Like, if you go to Wall Street, that is very unusual. You don't have, you know, people who are, trading public markets and private markets, and it's like the same analyst. But in blockchain, it's almost like you have to be like that, right? Because you're making early stage venture investments, but those investments are in decentralized networks that have a token very, very early in their life cycle. And that token becomes a publicly traded asset, like much quicker than private equity becomes public equity back in Web 2. And that being said, I also think that we, over time, are definitely specializing. Like, we have several analysts today who spend like disproportionately more time doing crypto liquid market analysis. We have other folks who are very, very focused on our venture discipline, which is Series A and Series B. And this is a little bit more, it's a little bit slightly different discipline than early stage venture, because now we're talking about companies with revenue, with product market fit, potentially, right? It's a lot more, it's a little bit more modeling heavy. It's a little bit more like, we got to analyze the EBITDA, right? So it requires like a little bit of a different set of skills than early stage venture, where we're talking to teams, we're deep digging into the tech, we're making calls about like, is this project viable? We're assessing the timing of companies. And so in summary, we're starting to see people specialize across different areas. And the CoinFund team is very multidisciplinary, right? We have people who come from finance, from investment banking, from computer science. We even have like biochem. We tend to try to cover the different areas with a diverse team.
Mm-hmm. I wanted to ask you, and I said this to you before we hopped on, like, what has been, in your 7 years, which again is a lifetime to have been in crypto investing, like, best performing, investments, worst performing investments. I don't think you can speak to CoinFund specifically for any number of reasons, legal and maybe otherwise, but kind of broadly, what do you see performing well? What has performed well? What has underperformed in your time in this space?
I would say, if, our strategy as an investor, especially as a venture investor, is to be thesis and trend driven, right? So what that means is we have a really good understanding of the technology and the mechanisms that are being built in the space. We are therefore able to identify the trends that are most likely to happen. Like if you look at, I know we talked about this on our panel at Permissionless, but I wrote about the NFT pricing problem in January of 2021, right? So that's about a year and a half ago. And only now are the companies that are doing pricing like Upshot, DeepNFTValue.com, NVal.com, and others, they're coming to market now, right? So like, what we are really good at CoinFund is saying, listen, we think like this is going to be a trend in the future. It hasn't arrived here yet, but we want to be really cognizant of that early. We want to talk to teams in those areas early. We want to find the best teams, and we want to positioned for those trends kind of like coming to fruition and becoming big. And that's what we've been good at. So, obviously we're like in 2015, super early to smart contracts, to Ethereum, to alternative blockchains that were doing smart contracts. We invested in Polkadot in 2017, right? As one of, as a statement almost that like we see a multi-chain world coming up in the future. We were pretty early to DeFi, kind of in Q3 or so of 2019. We're one of the earliest investors in the NFT space. I saw NFTs in 2016, and then CryptoKitties on the day they launched in around Thanksgiving 2017. We became Dapper investors in 2018 and pre-seeders of RARIBLE in 2020, and co-led or led a number of other rounds in NFT financialization companies like Upshot later on, right? And so, the most successful investments that we've had have been the ones where we formed a thesis early, we did our work, we positioned well, and the mission-driven founders of that vertical, drove that vertical to success.
I have so many questions. Of course, I've got to ask you what trends you see upcoming, what your next kind of bets are here. But let me ask you this, and maybe we cut it out or not, but that feels like a very macro style of investing, right? You see a big trend and then you can find companies within. But obviously, there's so many, a company can be riding the right trend and totally fuck it up. Are we early enough that generally speaking, you've seen, if you're betting on a company that has seen the trend properly, they're going to succeed simply because it just is so early and it's maybe not as fully competitive as the space might one day be?
That's a great question. So I definitely think that, you can be too early, and being too early can kill companies. Like I remember we were looking at a NFT marketplace, late 2017, early 18. And I think OpenSea started also in like mid to late 2017, if I'm not mistaken. But, it really wasn't something that people were paying attention to in the market. Like NFTs were not a thing. There was no VCs investing in NFTs or even dreaming of investing in NFTs. And like there were marketplaces that very well went out of business, even though OpenSea achieved this incredible success. So what was it about like OpenSea and other companies like that really made it work? Well, I actually think it's mission-driven founders. I mean, if you look at the OpenSea founders, to their credit, they had this incredibly strong long-term view that NFTs were going to be a thing at some point, and frankly, I shared that view. And to their credit, what they did was they just built for that, and they started building in 2017. But it wasn't until like February 2021 that NFTs really like had a huge inflection point and started doing like real kind of global business. And so from 2017 to 2021, that's almost like 5 years, I guess, or 4 years, where you have to be a mission-driven founder and kind of go for that thesis and go for that vertical. And that is to say, I think the combination of a mission-driven founder and the correct thesis is a powerful combination, because those founders hang in there and they make sure that at some point that vertical is a success.
So what are the trends that you're betting on these days?
Yeah, absolutely. NFT financialization. So as we spoke about at length in permissionless, and just to recap, that's the idea that NFTs are kind of a financial infrastructure for digital content, non-fungible goods, maybe even real world assets that are non-fungible, like real estate. And the financialization of those things means that we can create a bunch of financial services that can do finance on that asset class. And that starts with, in my opinion, really incredibly well-working price oracles, like what Upshot is building. And that primitive of reference pricing enables NFTs to be collateral. It enables short selling. It enables indices. It enables exchange of one NFT for the other, and really like a whole suite of these like financial services. NFT financialization is a huge trend. It's starting to ramp up now. The other area that I think has a lot of activity right now, but it's not like in the headlines, it's a little bit under the radar, is really like how much technological development has happened in Web3. And when I say Web3, I say it as a technologist. When I say Web3, I mean, the stack of networks and protocols and standards and frameworks that enable people to build truly decentralized applications, right? So, at the bottom of that stack is storage and computation. These are things like Filecoin and IPFS, right? It's also things like LivePeer, which are helping people to transcode video, or things like Akash, they're doing more general computation. Then you have this middleware layer in Web3, which has been already being built up for a number of years. So the middleware layer enables engineers and developers and founders, right, to create products on Web3, to actually put data into it, to compute things in a decentralized way. And these are things like The Graph, which is doing indexing, Ceramic Network, which is allowing people to store business data, Polywrap, which is creating APIs that Web2 developers can use, to access blockchains and protocols through a standard kind of programming interface. Many other type of things. And then all of those services, they get aggregated together, right? Like when we think about, as an engineer, like when we think about using AWS as our backend, what does that mean? Well, we log into the AWS console and we see storage and computation services, we see database services, we see domain name services, right? And that suite of services can also be implemented in like using Web3 protocols. You can do all of those things. And I call that DWS, right? Decentralized Web Services. One of our portfolio companies that is working on kind of this problem of bundling up kind of different backend services from centralized to Web3 is called Socket Supply. And they are, they're doing like really interesting work in terms of bridging the gap between, Web2 developers and Web3. And in the future, it could be maybe as easy as, just changing the endpoint of a Web2 app, and then suddenly your data lives in a decentralized network. And this becomes like an entry point into Web3, where these apps can enjoy some of the advantages and features, of what Web3 has to offer. And finally, that's kind of like where we are. We're sort of in this middleware infrastructure phase, but we're also starting to see decentralized apps on top. Like we see Mirror.xyz as being like used as a bit of like a decentralized Medium or Substack quite often in the crypto space. We see Orbis.club, which is a decentralized social media platform like Twitter, like a decentralized Twitter. We see Lens Protocol, which is building a social graph upon which other social protocols can be built. And that's because we now have enough infrastructure in Web3 to actually build these things and have them work reasonably well and in a user-friendly way. So Web3, it's still its kind of massive hype cycle, like we saw it with NFTs in 2021, but we will get there, and we're making incredibly fast progress on, that suite of services.
I feel like we've had cycles in the industry, and tell me if you agree with this, where it's like you develop kind of the back end infrastructure, the tools that developers need, and then you go through a cycle where it's very front facing building, and you're building for the consumer, and you're building on top of those tools that were built first, and then you go back to building the tools. It sounds like almost we're entering a phase where building both can be happening at once because the market's mature enough. Do you think that assessment is right?
It's absolutely right. We've been investing in infrastructure for a very long time. There's still a lot of infrastructure yet to be built, yet to be invested into, yet to be invented. But we, as I said, we're seeing a lot more of these experienced sort of consumer tech founders coming into the space. And we have enough infrastructure to actually take, some of these apps to market. Like when I think about DeFi, right? DeFi is full of technology already. Like there's DEXs, there's borrow-lends, there's derivatives, there's all kinds of DeFi primitives, but those primitives have not been taken to market in a form that most mainstream users can use on their phone, right? And one of our founders in our portfolio, he was the CEO of CoinLess. Andy Bromberg recently started a company called Echo, where, this is a really highly usable mobile app where you can connect your bank account, move some dollars over into your app, and then earn like an APY on that. And of course, it's coming from DeFi, but you never have to interact with DeFi yourself, right? And so we need like a lot more founders to like take DeFi to market in those ways, build up some great brand trust with consumers so they know it's safe to put money into these apps, and really demonstrate some of the power with which like DeFi services can compete with traditional such services.
I'm just like writing down names of companies that I now need to look up during this whole time. If folks see me writing, I'm just like, oh, ceramic, socket supply. I heard you in another interview, and it's funny. I think it was from like August of last year, which it feels like what's even relevant still from August of last year with the speed at which the space moves. But you outline various categories that you look at, and I think it was like the infrastructure category. I wrote it down as creating liquidity category, though I don't think that was exactly how you had phrased it. Marketplaces, getting IP through the door and getting them tokenized, and then like buy side companies like collecting NFTs, investing in NFTs. Would you say that's still sort of like 5 categories? I think that's 5 that you're where you play. Would you add to that list? Would you amend that list at all?
I'm not sure exactly which podcast you're alluding to.
This is Delphi Digital. It was an interview you did with Delphi.
Is it like the 150 minutes?
Yeah, 150 minutes of NFTs with Jake. Yeah. You weren't saying it in any sort of overly formal capacity, but it just gives me a structure because I would like to dive into a couple of these with you now. Marketplaces we talked about and some of the IP stuff.
So, and you're asking specifically like in the NFT space or just in general crypto?
I think in general, the places you play in, would those feel like the categories you're interested in?
I think if I were to categorize, it'd just be across kind of like the things that I see as crypto native verticals. So those would be DeFi, NFTs, Web3, DAOs, and kind of like everything else bucket, which we call infrastructure. But that could be, those could be decentralized networks like the Graph providing infrastructure, but it could also be companies like Blockdaemon, which is a very traditionally structured SaaS, providing like node infrastructure for people who want to run nodes on blockchain networks. And so those are kind of like the 5 categories usually I think about. Okay.
All right. Well, I'm gonna use these ones you mentioned in this Delphi podcast just as a way to dive into some topics, not to say that these are your categories. So, talking about marketplaces here, I think it's interesting. I think CoinFund and/or Metaversal have invested in. You mentioned you were an early investor in RARIBLE. I think you've invested in a company called MetaFlex, which basically is I think
Olaplex.
tooling. Olaplex.
Olaplex. It's a Solana kind of Shopify.
I could have sworn it said MetaFlex on your website.
It's built on MetaPlex, which is a protocol for.
I still got it wrong, huh? Even the MetaPlex version, I have it written as MetaFlex. Got it, MetaPlex. But yeah, it's basically tooling for folks to be able to build shops, backed by Solana NFTs. And I think you're seeing RARIBLE, I know, launched this year, I think, with Meta Angels, sort of these like white label marketplaces for different projects. Feels like overall it's a bet on many different marketplaces, and like marketplaces are going to be a commodity, so why not build the tooling that allow individuals to create niche marketplaces? Is that the bet you're making? Talk a little bit about how you thought about marketplaces.
Absolutely. Yeah. So my marketplace kind of thesis is that, like what we've seen is OpenSea, again, in a very mission-driven way, bring NFTs to market. They really like helped to take NFTs to early mainstream adoption. But they've done it in this model, which is a classical marketplace model. It's like an Amazon or an Airbnb or an Uber or something like that, right? Like a 2-sided marketplace. And as a matter of fact, that strategy was very successful, right? Like today, OpenSea volume is over 90% of probably like overall Ethereum network kind of GMV. But my thesis is that state of affairs is completely unsustainable. I think monolithic marketplaces will be decimated by this more Shopify type of model. And let me explain like why I kind of think that. So one reason is that this is this is not an Amazon, this is not a Web 2 situation, right? Like when you're talking about like Web 2 marketplaces, you're talking about people who own their own inventory. And in NFTs, this is an open protocol, and marketplaces do not own the inventory. What they can do is they can create an interface to the inventory that's open, public, and permissionless, and they can compete to be like the best attention seeker, the best place where everyone agrees to go to transact, the best user experience or something like that. But ultimately, marketplaces can't be, in NFTs, can't be as sticky as like Amazon is in Web 2, because ultimately someone can build a better interface and compete you away. That's much harder to do in the Amazon context, because it's much harder to replicate all these warehouses, international warehouses full of goods that I could just sort of steal and take away.
Wouldn't the analog more be like an eBay though, where it's a market maker between it's a marketplace in between a buyer and seller?
Absolutely. eBay is also a two-sided marketplace where a lot of sellers and buyers have agreed to meet. But here's kind of my point. What the marketplace model relies on is this peer-to-peer model to create liquidity. In other words, everyone in their mind has gotten this idea that in order to have a liquid NFT, I got to find a counterparty, I got to find a buyer, we got to do a deal, and we got to transact on one of these marketplaces, sort of one-on-one. And I just simply think that a lot of people will be very surprised that there's a lot more efficient ways of creating liquidity for NFTs. And my thesis is that like one of the ways you can do that is through reference pricing. If I have a machine learning model which tells me the price of all the NFTs out there, the fair price, then what I could do is I could start to create automated smart contracts where people can just transact and buy and sell NFTs with the smart contracts, or they can create liquidity around their NFTs through issuing loans, again, in an automated fashion. And what that does is it relieves me of having a marketplace model in order to have liquidity. And so here's what I think is happening. I think like people have realized that NFTs are exchange, just like token exchange, is going to move into decentralized protocols. And we have a number of projects out there that's confirming that trend. We have RARIBLE protocol, we have Zora, we have Reservoir protocol, we have Holograph, we have Metaplex on Solana, and even OpenSea just the other day launched Seaport, which is a decentralized protocol for NFT issuance and exchange. And so if NFT issuance and exchange is moving down into this protocol layer, what do you think is the next step? Well, obviously you do that because you want to give people an API, a backend that enables them to run their own marketplace. And having that kind of dedicated marketplace vision makes a lot of sense, because NFTs are art, but they're also in-game items. But artists don't want to be in the same marketplace where their art is sitting next to in-game items. We've also seen NFTs for real estate. We've seen NFTs for biotech. The experience of buying real estate should not be the same as the experience of buying crypto-native collectibles. And so you need a different kind of interface, a different kind of marketplace to serve those different use cases. And so if we believe that NFTs are going to be applied broadly to all of these different asset classes, like real estate, like stock photos, like movies, like music, and so on and so forth, then we realize we need a bunch of different marketplaces that give us different user experiences to traverse those markets. And of course, those marketplaces are going to be built on these protocols like RARIBLE protocol, like Zora, like Seaport, and so on. And so, Carly, we're heading in a world where 6 to 12 months from now, there's going to be an explosion of white labeled or dedicated marketplaces. Whenever a new series comes out, that marketplace is going to live on their website. Whenever a new artist launches something, you're going to be able to like go on their personal NFT marketplace and transact. And the thing is, like, there's not a ton of consumer behavior in the market today yet where people do that, but it's going to start to become really obvious that that's where we're going when people start building more and more and more white labels on these protocols that we mentioned.
RARIBLE is the NFT platform that's leading the charge into the multi-chain universe ahead of us. Available on Flow, Tezos, Polygon, and of course Ethereum, RARIBLE is the perfect place for NFT newcomers, profile picture collectors, and experienced NFT traders. RARIBLE has a variety of NFT features that set it apart from other NFT marketplaces. They have a native messaging function allowing you to DM your friends or haggle with sellers. They also have a mobile app on iOS and Android with a built-in NFT portfolio tracker tool, so you can easily check the value of your digital art portfolio. RARIBLE is built on the RARIBLE protocol, a multi-purpose, open source, and community-governed NFT protocol that helps build products and services across the NFT ecosystem, including white label marketplaces tailored to specific NFT communities. So go to rarible.com and start discovering and trading NFTs, putting in floor bids to join PFP communities, and DM with some brand new internet friends. It's increasingly obvious that everything will become tokenized, and NFT marketplaces needs robust financial reporting, performance analysis, and the peace of mind that they are compliance ready. GILDED's NFT Ops is a one-stop financial reporting solution for growing NFT platforms. GILDED has developed marketplace-specific modules to track the financial performance of NFT creators, including revenue tracking, collection metrics, royalty payments, and revenue share. Customers of NFT Ops gain full access to accounting tools and powerful APIs for custom integrations that simplify operations, streamline reporting, and produce tax-ready data. So no wonder why so many top brands like CoinMarketCap, Gitcoin, Nifty's, and POAP trust GILDED to automate complex reporting workflows. Visit gilded.finance/bankless to learn more.
So this is fascinating. I want to ask though, do we need to disentangle two pieces of this? Because it feels like there's almost two theses in this. One is the decentralization piece, which I think is really interesting. Like the NFT world starting to model the DeFi world more. And that makes sense that you have almost like automated market makers. I mean, that gets us into how do you determine fair price, which I really want to ask you about. But that makes sense to me. But then there's also this question of, and then also across these different verticals, whether it's, to your point, real estate versus art versus gaming assets, do those all need to be different marketplaces, or is there like a decentralized superstore network effect thing by having them all in one exchange? And I feel like I'm more persuaded by your argument on the decentralization piece than I necessarily am on that there won't be sort of a superstore where you can go to get an item in any of these verticals.
Well, I just find that it's really it would be a really difficult problem to take the wide variety of asset classes that NFTs could represent. And again, my example would be like fonts and, titles to your car, and I find it like, I would find it like very surprising that people would want to transact in those two dramatically different asset classes on one website using the same exact interface. And so inevitably the interfaces have to be different, right? Like for cars, like we know the checkboxes and the sliders that we would need for cars. Like, is it electric? What color is it? What brand is it? How much does it cost? And it's really sort of like a shopping experience. But if you're also presenting art, that's not necessarily the experience that you want. You want a beautiful website. You want it to represent your brand. You want it to be stylized for your brand. And it's not necessarily a tool where people move sliders to find the thing that they want. It's more like you're connecting with people on an artistic level, right? So just the deeply different kinds of experiences that are there in these two asset classes motivates us to think that like the stores, the shops that we're using to browse them will be very different. And it's just natural that in order to facilitate that, a lot of this activity moves into kind of a back-end layer, an API layer or a protocol layer, if you will. And then these experiences are sort of built on top. That's how these architectures tend to generally work.
Your font example is so fun to me. I have a good friend whose partner is going to school, basically becoming one of these people that creates new fonts. And I had no idea what an incredible process it is to be somebody who creates a new font and how much money these companies pay for bespoke fonts. And so it's a hilarious example that I don't think many people actually really realize the market behind fonts, and fascinating to think about it in an NFT context, which of course it ends up making a ton of sense in an NFT context because it is a digital good at the end of the day.
By the way, I love the font example, and I can't wait until people in NFTs people are using NFTs more for fonts, because like the font industry as a whole is not that, it's not a huge kind of like attractive space for investors. But I kind of feel like if you put that creation of fonts onto decentralized marketplaces, it'll actually like really democratize the creation of it. The creators will be like better compensated. It'll create like a much like an explosion of great fonts, and they'll be cheaper. And I think it's like a very positive thing that could grow kind of an unsexy market into really a very interesting market.
Yeah, gosh, I'm unfortunately I usually don't have hard stops on when I do these interviews, but I have a relatively hard stops. There's a whole thread I could go down on that, but I'm gonna save it. We're definitely gonna have you back on because I do want to go down the how do you price these things, and I feel like there's uh,
Yeah.
maybe two categories of that I want to ask you about. Metaversal, the fund, bought now number 9, and I think that's an interesting case of. Uh, um, how do you determine to make that bet and to bet on now number 9 when you don't have a ton of historical data? You've got a brand new kind of asset in some ways. And then when you talk about these protocols or whatever they are that are going to be determining fair price of NFTs, are they just
Hmm.
looking at historical value? Are they able to quantify intangibles like the community? Like, how do you deal with pricing in that context? And then how do you determine what you
All right,
invest in?
let me try to quickly cover both
And
those
I
things.
can go a few minutes over, but
Okay.
I just wanted to make sure we had time for this because I think this is a bear of a
I
conversation.
know, and this is a big topic, and we really could spend a whole episode on pricing. But essentially, so let me talk about pricing in general. So for companies like Upshot and Deep NFT Value, they've really emerged saying like we think machine learning is the best approach. And by the way, if you rewind back to a year and a half and read my article, it's called Appraisal Games and NFT Liquidity Problem. I really describe like a ton of different ways that pricing could happen. You can have auctions, you can have sales, you can have derivative implied pricing. You can have like various on-chain games. Actually, one was released on Twitter yesterday. There's a company called Abacus, which is doing a similar thing, right? There's like 14 different ways that you can approach that problem, but machine learning is kind of coming out, the most practical way. And it shouldn't be a surprise. Machine learning is really good at taking like quantitative factors and like learning about the right solution to your problem. And so machine learning inputs can be, historical prices, historical asks. They can be social media following. They can be like who's the creator of this series and how are they like regarded, or like what do they themselves buy in their wallet, right? Like there's all these like quantitative factors that you can figure out whether they are significant factors in price. Now, what are these pricing mechanisms like trying to do? Well, they're trying to get away from floor price, which is this like really rudimentary kind of statistic. The statistic really loses a lot of information about what's happening in a series. Again, your floor price could be crashing dramatically while smart money could be buying up mid or high priced items in that series like and hodling them like crazy. And you'll never know if you're only watching the floor price. When you apply machine learned pricing, what that does is it captures like all of the information in all of the series and maybe even like outside of the series, like in the case of social media, and then tries to basically come to, and there's a few different like philosophical ways of thinking about this, but it basically comes to like kind of a fair price that like the item like should be, and most people would probably agree that that would be a fair price. And of course that's based on like the rarity traits of the thing. If it's a collectible, again, it's based on how the market kind of like values those traits. It's also really interesting because, someone gave me the example the other day of the Fidenza, right? So the Fidenza is a generative art series and art blocks. And what's kind of interesting about Fidenza is that you can have the same kinds of parameters, like the same kinds of rarity traits, but visually, one of the outputs could be like very stunning, and the other one could be very plain. And so how does a machine learning algorithm like determine, sort of like the aesthetic value of a work, especially if they don't have past pricing information? Like Fidenzas are very expensive, so they don't transact a lot. And that's like a really interesting question. And I think that problem can also be solved with machine learning if machine learning can start to take into account like what the pieces actually look like, right? Anyway, so my whole point is machine learning is coming out to be this, kind of best way of doing it so far. Um, and like what is so interesting about this approach is that when a couple of reference pricing oracles come out there and get installed in the wild, people will start to look at those prices, and over time, customers will start to trust those prices. They'll start to market make against those prices, and they'll start to basically like believe that those are the prices that are real. And so in a way, it's a little bit of like a loop which teaches people what the prices are, and the people kind of confirm it. So that's on pricing. And then on nouns, and I'll try to be like super quick now.
Do your thing. Yeah.
Yeah.
Take your time.
On nouns, I think nouns are, and by the way, I'm noun number 4, full disclosure. And so I definitely had a hand in suggesting to Metaversal that this is an interesting series. But one of the reasons why I think it's so interesting is because it's not just about the art. It's also, very much a governance system. It's a DAO, and it's very much a financial opportunity, because this DAO takes the revenue from the daily nouns auctions and gives it to nouns holders to govern, right? And so one thing that really sets the nouns project apart from other projects is that if you own a noun, you have a governance right over a certain piece of that treasury. Actually, I ran that number a couple of days ago, and that number is approximately like 73 Ether. So if you get a noun, you kind of like govern about 73 Ether worth of the treasury. It doesn't mean you can take that out and keep it for yourself, but it means that you can help to allocate approximately that much Ether. And so if you're buying a noun at 45 ETH, but you're entitled to govern like 73 ETH, some people might think that is that is enough of a spread there to warrant like a good deal. And so
y'all paid a lot more than 45 ETH though, if I'm not mistaken.
So I paid 45 ETH for noun number 4.
Nice.
It was actually the second cheapest noun for a very, very long time. But then later on in the hundreds or 200s or something, people bought nouns for like 25, so cheaper than mine. And then, but to answer your question, Carly, right? Like how do we value nouns? Well, there's a very quantitative way of valuing nouns. It's like, what is the net present governance value, quote unquote, of like the future cash flows that you could affect when you own this asset?
What's so interesting on the machine learning piece of valuing things, I mean, I think it almost speaks to the discomfort that I feel a little bit, and that I'm sure others feel, which is you're saying you'll have this machine that can tell us what it's worth because it's really hard to know. Whereas if you're if you're Warren Buffett, you're looking at price to earnings ratio and free cash flow and these sort of very quantifiable numbers driven metrics that we just don't have for these more intangible assets. So then we kind of create these other metrics, which is just fascinating in and of itself. And I'm personally really interested in what we're seeing happen with NFTs, whether it's Coinbase casting Bored Apes for their Trilogy series, or, as we see NFTs now start to enter into licensing agreements and potentially be revenue generating in different ways, like how that then could get factored into pricing, right? Like, okay, you've got a Bored Ape that has a TV deal and brings in X number of dollars a year from their TV deal. And now that's also a saleable asset though. So, I think it's going to be so interesting to see how we price these things moving forward. Last question. You talked about GMV quite a bit here. Are there other metrics that you look at that you think we're not talking about enough as a space, in the space as a whole?
Yeah, so like in terms of NFT pricing?
Sure.
Or
Let's
NFT? Yeah.
NFT metaverse, that world.
Yeah. So absolutely, I think you got to look at GMV. I think another trick there is that global GMV now lives across many different blockchains, and so if you take that into consideration, you'll be getting better data. Floor prices are not irrelevant. They're still relevant, right? They are a summary statistic on what might be going on with a series, and sort of speak to like trends, especially if you're following floor prices over time, like give you good information. There's other summary statistics like median price, like historic sales. Um, there's probably like a bunch of, NFT traders are much better at this than me, but I suspect that like there are now metrics, like secondary metrics that you could calculate. For example, you could go to a series and you could say, okay, if I take the number of units and then divide it by the number of holders, like what number do I get? In other words, what's the average number of units per holder? And I kind of sense that like based on my experience, like series that where that number is like less than 2 is generally like very like highly distributed, like relative to different series of markets. And series where that number is like above 2 or even 3 are like very, very concentrated. So it's kind of almost a measure of like decentralization or distribution of a series. And I think like the more widely distributed an NFT series is, the more likely it's going to do better, right? So that could be like a secondary statistic that you use to assess health and things like that.
Yeah, number of holders. Awesome. Well, Jake, thank you so much. Again, would love to have you back on because we didn't get to fully traverse all of the topics we could traverse here.
Yeah.
But I'm so glad we were able to make something happen. We did cover a lot. You cranked it out. We were able to cover a lot in the time we had. Thank you so much again. Thank you so much for watching this episode of Overpriced JPEGs. If you liked this conversation, if you liked this episode, please go ahead and hit subscribe. It helps me out, it helps the show out, and it means you will get alerts and updates when we post new content. Thanks again.